Fundamentally, FSD Africa exists to close this financing gap that we hear a great deal about. We're about making capital markets work in order to provide a serious sort of developmental engine room for the goals and aspirations of the continent. As we all know, Kenya's government borrowing quintupled over the last decade, to the extent that debt service costs now absorb 60% of government revenue. The really pernicious effect of this debt overhang is, of course, that there's so little left for development and investment. And so this means it's doubly important for economic development, and I would argue for social cohesion, that we look to maximize the role of private capital markets to sustain the momentum wherever this is possible. The costs of dealing with climate disasters are astronomical, and countries like Kenya can't possibly afford these costs and still expect to deliver adequate economic growth. Currently, only $2 billion of the $30 billion of climate finance in Africa comes from the African private sector. How can we get that up to 100 billion? How can we scale the volume of private capital at work? What are those steps that we can work on together in order to get from 4 billion up to 100 billion by 2030? Unless financial markets give investors the viable projects with the scale, the credit quality, and the liquidity that investors need, the money just won't flow. So there's a lot of work to do. FSD Africa, we're particularly focused on the project development end of things. So, we can carry on building policy and regulation and working on capacity and so on. But actually none of this works unless there are other projects to invest in. And what we don't have yet is a systemic response by the donor or the development finance community to building a serious pipeline of large enough, good quality enough projects. And that's where we must all really, really focus our attention.
The objectives of the discussion today are threefold. One, we want to enhance market interest in sustainability. We think there is a good economic and business case for sustainable investments, and that sustainable investments are imperative. Secondly, we want to highlight the opportunities that exist for capital markets to mobilize private and green capital for Kenya and the African continent. And thirdly, we want to explore in quite practical ways together the range of innovative financial solutions that have the potential to unlock financing for Kenya and for the continent.
This slide basically presents the size of the financial market in Kenya compared to some of the peer countries. As you can see, that has been shrinking. Today, we have equities market capitalization to GDP, which we use as a measure of market depth at 9% of GDP. That has come down all the way from about 30% in 2012, and it's now similar in size to Nigeria. It's not very encouraging. And then when you look at the corporate bond market, we are talking about 0.2% of GDP. Basically the picture I'm getting is that we have gone back to 2002, in very, very many things. If you're going to go to the next level and rebuild, recalibrate the markets, we have to think about it in a slightly different way with the sustainability or sustainable investment mindset. In 2014, Kenya did a study called Green Economic Assessment Report. And what that report indicated is that by 2030, Kenya's GDP can be higher by 12% by taking a green economic pathway, relative to continuing on a business as usual basis. So there are opportunities clearly for going this route. But we do also know that going this particular route also means that we can also improve or enhance the well-being of the people by reducing air pollution, improving health outcomes, reducing congestion, and of course creating opportunities to live in a more attractive environment.
When we look at the realities we have on pricing, and especially when we start talking about guarantees, a guarantee layer, how are we affecting the sustainable viability of these market-based solutions, especially when we start looking at some of the pressure we're seeing from public debt markets and ever-escalating risk-free rates?
History has shown in both small and very, very large markets that the guarantee product can be extremely efficient in the allocation of capital and risk, and therefore the sum total cost is materially less than that of the unguaranteed option in particular cases for particular types of issuances. So from where we sit, we would only do these types of things if we can convince ourselves that we can materially reduce cost to issuer.
How do you, Cecilia, deal with this whole issue about greenium or greenium? And so people saying, oh, it costs too much to do all the reporting, and we'll only do a green bond if we can get a decent premium on that.
You look at the total cost of capital, and FSD Africa has done that, does that analysis for companies who want to come and issue. Look at what would the comparative cost be if you go and raise the capital elsewhere. And the opportunity that is there specifically with green bonds is that you can blend with concessional finance. There's so much interest and support to build momentum in the local capital markets, that there is opportunity for innovation and to bring the total cost down because you can blend in concessional finance.
We've seen a trend over the years where capital is moving in the direction of capacity. So the conversation is very much around adequacy of capital as opposed to innovativeness that is required to move capital, particularly from dormant capital to productive capital. So it would be good to hear your thought about that missing gap, of increasing capacities in order to be able to make that transition.
I think you've rightly said that the capacity is an issue. And I think on the innovation part we've had was to going forward to look at the like-minded entities. Currently, we are a strong partner of the World Bank on the continent. I think we're the first institution to start working with the World Bank on branded finance. So they give us both debt as well as technical assistance on the technical assistance to support our member states, as well as also supporting the entities that we work closely with.
There's a lot of discussion we've had today about sustainable capital and sustainable finance. So in your view, being on the supply side, is Africa really ready for issuing products that can raise sustainable capital?
The focus on the ESG matters or on the high impact sectors, education, healthcare, gender inequality is something that it's raising more and more interest from investors. From the SME side, it's also, we see a lot of interest and a lot of projects that would comply to these impact KPIs, but they lack the adequate financing for them.
Just to follow on that, I will now ask Josephat, from their experience as Kengen, how have the innovative financial structures or blended financial structures assisted them in investing in private debt, and how also it has crowded in additional institutional investors into the fund?
I believe African problems requires African solution. Talking about local guarantees, because most of the time when we talk about private debt issues, the issue of guarantees, they talk about the cost of these guarantees. If we can get guarantees at a local currency, most likely they will be cheaper, priced lower, meaning that even this debt instrument will be competitive as compared to any other debt or even if it's public market. The bigger problem which is even affecting us at the moment is the currency issue. Most of our commitment is in dollars, and you can completely understand where we are. We have given commitments; it's expected to be paid in dollars. Where do you get the dollars? Most of these fundraisers are fundraising in dollars. If we'll get people looking for local currency debt, it will be easier for pension schemes. They not also feel like they are investing for people who go and invest outside there. If you're investing locally, it will become a good issue.
Now with that, I would also like to ask Thembi to give us a view on what they consider as an anchor investor in providing long-term finance capital, and what are some of the requirements or partners that they usually work with in providing such kind of capital.
If you are looking to do an inaugural bond or you're looking to do a large bond, I would encourage you to bring in an anchor investor. So with the anchor investor, you're bringing in someone upfront who commits to a certain amount under your issuance, and there's a number of benefits to that. I think one of the things that's very key for us in terms of our requirements for us to be an anchor is we need to be brought in early, because we have a need to do a full due diligence around ESG and any other matters that are important to us. As anchors, we provide clarity around the use of proceeds, and normally, as I've just mentioned, as anchors, we have in-house expertise around climate, around gender, around ESG teams. So we help to support you in reviewing and finding the right assets for your issuance.